Imagine popping champagne over your company's massive new European acquisition.
Best feeling in the world, right?
Oh, exactly. You're feeling great. But then, only to realize a few months later that a single, mistranslated line on a tax form is about to trigger a $10,000 penalty.
Per entity.
Right, per entity. And it could potentially open your entire corporate history to an indefinite IRS audit. I mean, picture this. You or the business you work for just pulled off a phenomenal strategic move. You acquired a significant controlling stake in a highly profitable foreign corporation.
Like a manufacturing plant in Germany or something.
Yeah, or a booming tech startup in Singapore, or maybe a sprawling logistics hub in Brazil. And you are feeling incredibly confident about your global expansion. The press releases have gone out, the board is thrilled, the champagne is gone.
The honeymoon phase.
The honeymoon phase, exactly. And then, well, reality hits. Your tax professional walks into your office, sighs heavily, and just drops this massive, incredibly complex, multi-page document right in the middle of your desk.
Good old Form 5471.
Form 5471. It's an information return. And when you start leafing through the instructions, you realize it essentially demands that you reconstruct the entire granular financial life of that newly acquired foreign company.
But completely translated into United States tax and accounting standards.
Which is an absolute beast of a document. And your first thought is probably, where do you even begin?
It is a profoundly overwhelming moment for a lot of taxpayers. And frankly, even for seasoned accounting professionals who are maybe new to international work.
Oh, for sure.
Because you are looking at a document that asks for a level of granular financial detail that you might not even require for your own internal management reporting.
Right.
But the reality is, if you are a United States person who owns a certain percentage of a foreign corporation, this form is, well, it's your new reality. It is the absolute cornerstone of international tax compliance.
And that is exactly our mission today. Welcome to our deep dive into the source material covering Form 5471. Today, we're specifically tailoring this deep dive to guide you through the core financial schedules of this form.
The really fun stuff.
The really fun stuff. We're going to focus heavily on Part 1 of these financial requirements. So that's Schedule C, which is the income statement, and Schedule F, which is the balance sheet.
Right.
And our goal over the course of this conversation is to take this intimidating stack of IRS instructions, Treasury regulations, internal penalty guidelines, and just extract the absolute essentials. We want to transform this overwhelming compliance burden into a logical step-by-step workflow.
So you can actually sleep at night.
Exactly. By the end of this, you should be able to look at a foreign trial balance and confidently understand exactly how it needs to translate into the IRS's very specific requirements.
Which is huge. And, it is completely valid to feel some anxiety about this process. International tax compliance is not exactly known for being intuitive or forgiving, for that matter.
Definitely not forgiving.
But understanding why this matters can actually help reframe that anxiety into, strategic clarity. The IRS uses these specific schedules, Schedule C and Schedule F, to basically peer into the financial soul of a controlled foreign corporation, or a CFC.
They aren't just collecting data to file it away in a cabinet.
No, not at all. They are hunting for very specific things. They're looking for hidden offshore income that should rightfully be taxed in the U.S. They are verifying proper currency translation to ensure gains aren't being masked by exchange rates.
Right.
And they are intensely scrutinizing intercompany transactions to ensure no one is playing, shell games with global profits.
Okay, so let's unpack this, because before we even get into the weeds with the math and the accounting and the translation, we need to talk about the stakes.
We do.
And the stakes here are, frankly, terrifying. When we look at the Internal Revenue Manual, specifically Section 20.1.9, which deals with international penalties, it becomes immediately clear that if you get Form 5471 wrong, or if you just, forget to file it because you thought the foreign entity was too small to matter.
Which happens a lot, actually.
I bet. The IRS just does not mess around here.
They really do not. The penalty regime surrounding international information returns is intentionally designed to be punitive. It's meant to force absolute, uncompromising compliance.
Yeah.
So, according to the internal guidelines we are reviewing, an initial penalty is asserted on Form 8278. They use what they call Penalty Reference Number, or PRN 625.
Okay.
If you are a C corporation,
Right,
and you fail to make a required disclosure on this form, you are looking at a $10,000 penalty under Section 6712.
Wait, $10,000? Just for messing up the paperwork?
Exactly,
Yeah.
just the paperwork. And you have to realize that is just the starting point, that $10,000 applies per form per year. So if your company owns 10 foreign subsidiaries, which is very common in global structures, right?
Oh, absolutely.
And you mess up the filing methodology for all of them, that's a $100,000 penalty right out of the gate before a single dollar of actual tax is even assessed.
Let me stop you right there. Because if the penalty for a single mistake is $10,000, I'd be terrified to even look at my, German or Italian subsidiaries' bookkeeping.
Right. Yeah.
Because they use totally different accounting standards. How on earth do you protect yourself when translating their local books? Because you might naturally think, hey, I filled out 90% of the form. I gave them the basic income and assets. I did my best. Isn't that good enough for government work?
That is the exact trap that catches so many filers. There is a really fascinating IRS Field Service Advice memo from 1997 that completely changed how practitioners have to look at this, and it directly addresses what you just asked.
The 1997 FSA.
Yeah, this memo tackles the whole concept of substantial compliance. The IRS explicitly rejected what they called the aggregate approach. You do not pass this test by getting 51% of the form right.
Or even 90% right.
Not even 90% right if the missing 10% is meaningful.
So, zero partial credit here.
None. The IRS stated in that field service advice that compliance is judged on a significant item by significant item basis. Congress did not intend for taxpayers to just provide, quote, more of the required information than not.
Wow.
Every single required schedule, every required line item that applies to your category of filing, it has to be completely accurate. If you have significant understatements of related party purchases or inconsistencies in your earnings and profits reporting across different schedules, you have failed the substantial compliance test.
And boom, the penalty hits.
The penalty applies just as if you had taken the form and thrown it straight in the shredder.
It's like taking a complex, high-stakes calculus test where getting the final answer right at the bottom of the page doesn't matter at all if you skipped showing your work on step 3.
That's a great way to put it.
You can't just hand in a mostly correct return and hope the IRS grader gives you a passing grade for effort. The IRS wants every single significant puzzle piece perfectly shaped, or they fail you.
Precisely.
And when we look at the guidance, there are some incredibly common reasons for these failures too. Things that seem like minor administrative shortcuts, but are actually fatal flaws.
Yeah, the 1997 memo highlights several recurring errors that IRS examiners are actively instructed to look for on the face of the return. One of the most common, and frankly most egregious from the IRS's perspective, is the taxpayer simply stating on a line item that the required information will be furnished upon request.
Wait, people actually write that, like, hey, IRS, trust me, I have the numbers, just call me if you really need them.
They do, usually when they're rushing to meet a filing deadline and haven't finished reconciling the foreign books. But that is an immediate automatic failure. You cannot treat Form 5471 as an IOU for future financial data.
That's wild.
Another massive trap is using unapproved computer-generated forms that don't precisely conform to the IRS formatting requirements. If your software generates a schedule that, say, drops a column or changes the line numbering, it can be outright rejected.
Just for a formatting glitch. And then there's the big one regarding financial statements. People either fail to provide the financial statements for the controlled foreign corporation entirely, or, and I bet this happens constantly in big corporate mergers, they provide consolidated financial statements of 2 or more foreign corporations instead of separating them out entity by entity.
Oh, this is a crucial point to understand, because it explains the underlying philosophy of the form. The logic behind the IRS's strictness makes perfect sense when you look at the actual mechanics of it. The entire purpose of Section 6038, which mandates these information returns, is transparency at the granular entity level.
Right, they want to see the individual trees, not just the forest.
Exactly. If a United States person simply hands the IRS a consolidated financial statement that rolls up, let's say, 5 different European subsidiaries into one neat, unified European profit number, the IRS is completely blinded. They cannot see the entity-by-entity intercompany transactions.
Because it's all washed out in the consolidation.
Right. Let's say you have subsidiary A in Ireland, which has a very favorable corporate tax rate, and subsidiary B in Germany, which has a higher rate. If you consolidate them, the IRS can't see if the German subsidiary is artificially shifting its profits to the Irish subsidiary through, inflated intercompany licensing fees or management charges.
Ah, I see.
Consolidated statements defeat the entire purpose of the form, which is to track exactly where the money is moving globally.
Okay, so let's play this out. What happens if you're listening to this right now and a cold sweat breaks out? because you suddenly realize the return your internal team filed last month had one of these fatal flaws.
Panic.
Yeah, maybe they consolidated the European division. You can't just wave it off and promise to fix it next year.
Right.
Right. You have to fix it now.
Absolutely. You must fix it. And the instructions are very, very clear on the remediation process. If you realize you have filed an incomplete or incorrect Form 5471, you must file a corrected Form 5471. And this isn't just a matter of quietly mailing in a new form to replace the old one.
Which would be nice.
It would be, but no. It must be formally attached to an amended tax return for the year in question.
Which is a massive deal.
It is a huge deal. You have to physically write or type the word corrected at the top of a form, and you must attach a specific statement identifying exactly what changes were made from the original filing. You have to formally reopen that tax year to fix the error.
Yikes.
Yeah, when you file an amended return, you are drawing a bright red circle around your file for the IRS. Furthermore, if you failed to substantially comply in the first place, your statute of limitations for that tax year may not have even started running.
So it's open forever.
Basically. That is why getting it right the first time, mapping it out meticulously, is absolutely paramount.
Which brings us to the actual execution. How does a tax professional actually get from a local foreign trial balance to the specific, highly regulated lines on Form 5471? Because before you even look at Schedule C or Schedule F, you have to gather the raw data.
Right.
And that journey starts with obtaining the foreign corporation's trial balance. So let's walk through this practical workflow.
This workflow is where the theoretical pristine tax law crashes headfirst into the messy reality of global business operations.
Oh, I'm sure.
You are generally dealing with a local accounting team in the foreign jurisdiction. They are keeping the books in their local currency according to their local accounting standards, which might be radically different from what U.S. GAAP or the IRS expects.
Right.
The U.S. tax preparer has a massive job of translation ahead of them. And I don't just mean translating German or Japanese into English.
Right. It's a philosophical translation. It's a structural translation.
Yeah.
Working with these local accountants is absolutely crucial because you have to ensure the proper classification of items that might be treated fundamentally differently under their local business customs.
Precisely. Let's look at a really common example. Financial instruments. Is a payment leaving the foreign company truly interest on a loan, or is it actually a dividend distribution of equity?
Right.
Or, should a specific type of expense be slotted into cost of goods sold, COGS, meaning it's a direct cost of producing inventory, or should it be classified lower down the income statement as a selling, general, and administrative expense, SG&A?
But wait, let me jump in here. Why does the IRS care if it's COGS or SG&A?
Yeah.
It's an expense either way, right?
Yeah.
It reduces the final profit either way.
It reduces the final profit, yes. But where it sits on the income statement dictates how it interacts with other highly complex U.S. tax calculations, specifically earnings and profits and Subpart F income.
Okay. How so?
If you artificially inflate cost of goods sold, you are directly reducing gross income. Subpart F income, which is a mechanism the U.S. uses to tax certain passive or easily movable offshore income immediately, often relies on gross income thresholds. So if you misclassify SG&A as COGS, you might be illegally shielding income from U.S. taxation without even realizing it.
That makes total sense.
And going back to the debt versus equity issue, a local accountant in Italy might categorize a certain hybrid financial instrument as debt and the payments on it as interest because Italian local commercial law allows it.
Right. They're just doing their job according to their rules.
Exactly. But under rigid U.S. tax principles, that same instrument might have too many equity-like features, meaning the IRS classifies it as stock, and those payments are actually dividends. So if the U.S. preparer just takes the Italian trial balance at face value, assumes interest means interest, and drops those numbers onto Form 5471, the return is fundamentally incorrect.
I have to push back on the reality of executing this, though. I mean, it sounds logical on a deep dive like this or in a textbook to just say reclassify things. But if you're a mid-market U.S. company dealing with a local accountant in a different time zone who barely speaks English and who was trained under a totally different accounting philosophy, how do you actually bridge that gap without spending millions of dollars on elite multinational accounting firms to audit every single receipt?
It is arguably the most operationally difficult part of the process, and you are right to highlight the cost and friction. The U.S. preparer cannot rely on ad hoc manual adjustments at the end of the year in a messy Excel spreadsheet. To survive this, a company must implement a rigorous, standardized chart of accounts.
Walk me through what that actually looks like in practice.
You take the raw local trial balance straight from their local accounting software. The very first step is mapping those hundreds of local accounts to a standardized US-style chart of accounts. You have to establish a clear, documented audit trail.
Like a master key.
Exactly. Account 4050 in the Italian system equals account 600A in the US standardized system. Only after you have mapped the local books to a standardized chart and reviewed that mapping for philosophical differences, do you then map that standardized chart to the specific lines of the Form 5471.
Right.
It has to be a replicable, documented process so that if the IRS audits you 3 years later and asks where a number came from, you can trace it all the way back to the original local entry.
And it's not just about what categories the money falls into. The regulations actually dictate the timing of the accounting itself, right? Like how we recognize when money is earned or spent.
Yes. Under Treasury Regulation 1.6038-2, there is a specific mandate regarding the accounting method. If the foreign corporation uses an accrual method of accounting for its own books, meaning they record income when it's earned, not when the cash is received, and expenses when they are incurred, not when the bill is paid, the U.S. preparer must use those accrued payments and accrued receipts for purposes of computing the transactions listed on the form.
So I can't just call up the local manager, ask for their bank statements, and build a quick cash flow analysis.
Absolutely not. You cannot rely on cash receipts and disbursements if the underlying books are accrual. It forces the U.S. parent company to deeply understand the foreign subsidiaries' balance sheet accruals, their accounts receivable, their accounts payable, not just the balance of their checking account.
Here's where it gets really interesting, because all of this mapping and translating we just talked about becomes formalized when we hit the core income statement, Schedule C. This is where the rubber meets the road.
Oh, yeah, Schedule C.
Schedule C requires the foreign corporation's profit and loss statement for the year. But the absolute most critical rule here, etched in stone in the instructions, is that it must be reported in accordance with U.S. Generally Accepted Accounting Principles, or U.S. GAAP.
Which is a massive hurdle. Let's visualize the form for a second. The instructions dictate that Schedule C requires two distinct columns. First, you have the functional currency column on the left. This must reflect the income and expenses in the foreign company's functional currency, say euros or yen, but, and this is the vital key, computed in accordance with U.S. GAAP.
Right, still U.S. GAAP.
Still U.S. GAAP. Second, you have the U.S. dollars column on the right, which takes that first column and translates it into dollars using U.S. GAAP translation principles.
I like to think of this using an analogy of like translating a novel. When you fill out Schedule C, you aren't just taking a dictionary and translating the language from, say, French to English. You're taking a French existential, deeply philosophical tragedy, and you are being forced to rewrite it so it has the rigid, three-act structure and happy ending of a blockbuster American Hollywood script.
I love that.
You are translating the underlying rules of the story, the actual accounting principles, not just swapping the numbers into a different column.
That is an incredibly accurate way to frame it. You are analyzing the profound friction between local accounting standards, U.S. GAAP, and ultimately U.S. tax books. A foreign company's local statutory books might allow for certain accounting methods that U.S. GAAP strictly forbids.
Give me a tangible example of that friction. Like, where does the French tragedy conflict with the American script?
Contingency reserves are a classic example. Let's say your German subsidiary is facing a potential but unproven lawsuit from a supplier. Under their local accounting rules, the local government might allow them to establish a massive contingency reserve, essentially a rainy day fund, and deduct that reserve as an expense immediately.
Oh, wow.
Which drastically reduces their local net income and their local tax bill.
They just guess how much they might get sued for and deduct it.
Nah.
I imagine U.S. GAAP must hate that.
U.S. GAAP despises vague contingency reserves. Under U.S. GAAP, you generally cannot expense a general contingency reserve unless the liability is both probable and the amount is reasonably estimable.
Makes sense.
So the U.S. filer has to systematically identify those local assumptions, like that massive lawsuit reserve, rip them out of the trial balance entirely, and recalculate the net income using U.S. GAAP rules before they even begin to fill out Schedule C.
Right.
If you just take the German local statutory net income, which includes that illegal reserve deduction, and drop it onto line 22 of Schedule C, you are filing a fundamentally false return.
Let's dig into some specific lines on Schedule C, actually, because they point to specific complexities, like line 8 tracks foreign currency transaction gain or loss, and line 24 tracks other comprehensive income, or OCI. These aren't just standard we sold widgets revenue lines. They feel very specialized.
They are highly specific areas of accounting risk that the IRS monitors closely. Line 8 is looking for realized gains or losses that occur when a business conducts a transaction in a currency other than its own functional currency.
Okay, walk me through how that actually happens day to day.
Sure. Let's say you have a British subsidiary whose functional currency is the British pound. They agree to buy €1 million worth of raw materials from a supplier in France. On the day they receive the invoice, the exchange rate is at a certain level, and they record an account payable.
Okay, straightforward so far.
But they don't actually pay the bill for 60 days. In those 60 days, the British pound weakens against the euro. When they finally pay the bill, it costs them more pounds to buy those €1 million than they originally recorded.
Right, because of the exchange rate shift.
Exactly. That difference, that extra cost generated purely by the passage of time and exchange rate fluctuations, is a realized foreign currency transaction loss. That specific phenomenon has to be isolated and reported on line 8.
So the IRS wants to know exactly how much money you made or lost just by holding different currencies.
Yep.
What about line 24? Other comprehensive income.
Line 24, other comprehensive income, captures items that U.S. GAAP says are important to track but shouldn't hit the main bottom line net income yet. These are things like unrealized gains or losses on certain types of financial investments or specific adjustments related to foreign pension plans.
Gotcha.
The fact that the IRS demands this specific line item proves that they are not just looking for a rough estimate of profits. They are demanding a fully compliant, rigorous U.S. GAAP financial presentation.
But wait, all of this mapping, translating a U.S. GAAP adjustment relies on one massive assumption, that we even know what currency we're supposed to be doing the math in. We keep saying functional currency column. How does a taxpayer actually determine their reporting currency versus their functional currency? Because it's not always as simple as the company is located in Japan, so obviously the functional currency is the Japanese yen.
It isn't always that simple, no. And getting it wrong cascades through the entire return.
Yeah.
The functional currency is generally defined as the currency of the primary economic environment in which a significant part of the CFC's activities are conducted. And, which is used in keeping its books and records. Usually, yes, it's the local currency of the country where they operate.
But when is it not?
Think about a Japanese subsidiary that manufactures specialized electronic components. They are physically located in Tokyo. They pay their rent in yen. But let's say they import all their raw materials from the United States, paying in US dollars.
Okay.
And they export 95% of their finished products to American tech companies, receiving payment in US dollars. Their pricing is in dollars. Their primary market is in dollars.
I see where this is going.
In that scenario, even though they are located in Japan, their functional currency for U.S. tax purposes might actually be the U.S. dollar because that is the currency of their true economic environment.
That makes sense. You look at the actual substance of the business, not just the GPS coordinates of the factory.
Exactly.
But there's a fascinating and frankly chaotic exception to all these standard currency rules. DSTM, the Dollar Approximate Separate Transactions Method. This is governed by Treasury Regulation 1.985-3.
Yeah.
And this comes into play when a foreign corporation operates in a hyperinflationary environment.
DSTM is essentially an emergency override switch for currency translation. It is a highly specialized accounting method. If a country's currency is experiencing hyperinflation, which is generally defined by the regulations as cumulative inflation of 100% or more over a 36-month period, the standard accounting translation rules completely break down.
They just stop working.
They produce absurd, economically meaningless results.
Imagine trying to measure the length of a moving car using a ruler made of stretching rubber. That's what accounting in a hyperinflationary environment is like.
Yeah.
If I'm running a business in a country where the local fiat currency loses half of its purchasing power over a long weekend, how on earth does the IRS expect me to report a coherent, static year-end number on a tax form?
You really can't.
Because 1 million local currency units in January might buy a factory, but by December, that same million units might barely buy a cup of coffee.
Exactly. If we connect this to the bigger picture, DSTM exists precisely to prevent those massive artificial tax distortions that would occur if you use standard rules. Under standard translation rules, you generally take the balance sheet, which is loaded with hyperinflated local currency, and translate it at the end of your exchange rate.
Right, the snapshot on December 31st.
But if you do that in a hyperinflationary economy, the results are catastrophic for tax reporting. A highly profitable, well-run U.S. subsidiary might look utterly bankrupt on paper because the exchange rate collapsed by 900% in December.
Oh, wow.
Or, conversely, a failing business that holds a lot of hard assets might generate massive phantom taxable gains simply because the local currency's value vanished against the dollar. It breaks the fundamental requirement that tax should be based on real economic income.
So how does DayStem actually fix the rubber ruler? Mechanically, how does a tax professional apply Treasury Regulation 1.985-3?
Under DayStem, if a CFC is operating in a hyperinflationary environment, its functional currency is legally forced to be the US dollar for US tax purposes, regardless of its local economic environment.
Interesting.
On Schedule C, the functional currency column still reflects the local hyperinflationary currency amounts, but they are computed in accordance with US GAAP.
Okay, so you still have the local crazy numbers on the left.
Yes. Then the US dollar column on the right translates those amounts into dollars under very specific, highly granular US GAAP rules designed for highly inflationary economies. This usually involves translating different line items at different historical exchange rates rather than just one year-end rate.
Which is a massive headache, I'm sure.
Oh, a huge headache.
Yeah.
And the differences between this US dollar GAAP column and the US dollar income figured for pure tax purposes under the Distack-Arm regulations must be meticulously accounted for later on Schedule H.
It essentially forces the company to track its economic reality in a stable currency, the US dollar.
Right.
So the IRS can measure actual economic gain or loss rather than just forcing the taxpayer to pay taxes on the collapse of a foreign fiat currency.
Right.
It links directly into earnings and profits calculations, and it touches on Section 987 issues, which govern how branches deal with currency transactions. It's an incredibly specialized area, but if you are operating in certain volatile parts of South America or the Middle East, knowing DAS-TAHAM isn't just optional tax trivia, it's absolute survival for your corporate balance sheet.
Precisely. You are translating volatility into stability so the IRS can measure it. And that transition from the dynamic, year-long income flow of Schedule C brings us perfectly to the static, frozen snapshot of Schedule F.
Schedule F, the balance sheet. This is the US dollar snapshot. If Schedule C is the feature-length movie of your financial year, capturing all the action, the drama, the money coming in, the expenses going out over 365 days, Schedule F is just 2 Polaroid photographs.
I love that analogy, too.
Yeah. One photograph taken at the exact beginning of the annual accounting period, usually the morning of January 1st, and one photograph taken at the exact end, the night of December 31st.
That is the perfect analogy for the difference between an income statement and a balance sheet. Schedule F requires the reporting of assets, liabilities, and shareholders' equity for those 2 specific frozen moments in time. It shows the IRS the accumulated wealth and leverage of the entity.
Okay.
But unlike Schedule C, which requires that dual-column presentation of functional currency side by side with US dollars, the instructions for Schedule F state that it is reported solely in US dollars.
Wait. Solely in US dollars. Even if the books are in euros and we determine the functional currency is euros, the balance sheet form just wants dollars. Walk me through that.
Yes. Generally, the foreign corporation's balance sheet is prepared and maintained in its functional currency, like euros. But for the purposes of filling out Schedule F, it must be translated entirely to US dollars using US GAAP translation rules. The IRS wants to look at the total global assets of a U.S. multinational corporation and understand its total asset base in one unified currency. The only major exception, again, is if the DAS-TAHAM rules apply, in which case you follow the DAS-TAHAM translation rules under the Treasury regulations rather than standard GAAP translation. But the end result on the paper form is a pure U.S. dollar presentation.
We have specific line items that the preparer has to pull from that standardized trial balance we mapped out earlier.
Yeah.
Things like retained earnings, which is the accumulated profits over time paid in or capital surplus, the cost of treasury stock, and carefully breaking out preferred stock versus common stock. The IRS wants to see the exact structure of the equity.
They do.
But when you dig into the core instructions for Schedule F, there's a massive, glaring trap waiting on lines 3 and 17, derivatives.
Yes. This is an area where taxpayers frequently make critical, sometimes devastating errors. Lines 3 and 17 require the reporting of derivatives. The instructions explicitly state that derivatives must be reported in accordance with ASC 815, which is the U.S. GAAP standard for derivatives and hedging.
Right.
And the most important sentence in the entire instruction block is this: do not net positions. You must enter the total asset amount of derivatives on line 3 and the total liability amount on line 17.
I have to ask a specific pushback question here because from a pure pragmatic business perspective, this sounds crazy.
Okay, let's hear it.
Why is the IRS so obsessively strict about not netting the derivatives? Let's say my foreign company has a complex interest rate swap with a major global bank. Under one part of the swap, I theoretically owe them $10 million, but under a corresponding hedge with the same bank, they owe me $10 million. My actual mathematical net risk is zero. Isn't the value just zero? Why make me report massive assets and massive liabilities if they cancel each other out?
Because netting hides both scale and systemic risk. The IRS does not just want to know your net bottom line, they want to understand the true gross exposure of the controlled foreign corporation. If you net those positions to zero, the IRS looks at Schedule F and thinks, oh, this is a conservative, low-risk manufacturing company with no complex financial instruments.
Right. They see a zero and move on.
Exactly. But if they see $500 million of derivative assets on line 3 and $500 million of derivative liabilities on line 17, they immediately realize, wait a minute, this CFC is engaged in massive, highly leveraged financial trading or hedging operations.
Oh, I see.
It completely changes the risk profile of the entity. Even if the current net position is near zero, the gross exposure tells the IRS that this entity is operating a massive financial engine that could generate huge gains or catastrophic losses if one of those counterparties defaults.
Ah, so it's about seeing the size of the casino, not just how many chips you have left in your pocket at the end of the night.
That is exactly it. Gross exposure tells a story of systemic risk and operational scale that net exposure actively conceals. Beyond derivatives, there are other common critical issues with Schedule F that examiners zero in on. Missing intercompany balances are a huge red flag. Or misclassifying related party payables and receivables.
How does that happen? Give me a scenario.
Let's say a U.S. parent company loans its German subsidiary $50 million to build a new factory. If the preparer carelessly classifies that $50 million loan as generic third-party debt on the German subsidiary's Schedule F, rather than explicitly listing it as a related party payable, it creates a massive issue.
Because it doesn't match up.
Exactly. Because when the IRS cross-references that Schedule F with other schedules that track related party transactions, it will trigger an immediate discrepancy. The U.S. parent will show a $50 million receivable, but the subsidiary won't show the corresponding related party payable. It looks like $50 million just vanished into thin air.
Which is the perfect organic transition into our final main topic, the ecosystem.
The ecosystem.
Because these schedules, Schedule C, Schedule F, Schedule H, Schedule M, they do not exist in a vacuum. They aren't separate, isolated homework assignments you can hand to different departments and forget about. They are a deeply integrated, highly sensitive mathematical ecosystem, and they must tie together perfectly.
This is where the complexity of Form 5471 truly compounds, and where that substantial compliance penalty we discussed at the very beginning usually gets triggered.
Right, the 10 grand.
Yep. Let's look at Schedule H, which is the calculation of current earnings and profits, or E&P. Earnings and profits is essentially the tax concept of retained earnings. It dictates how much of a distribution to a shareholder is taxable as a dividend. Schedule H does not start from scratch. It doesn't ask you to recalculate income.
It pulls from elsewhere.
It starts by pulling a specific number directly from Schedule C.
So it's a chain reaction.
Exactly. Specifically, if the books are maintained in functional currency under U.S. GAAP, Schedule H starts by taking the functional currency GAAP net income straight from Schedule C, line 22, and dropping it onto the first line of Schedule H.
So what does this all mean for the preparer? It means Schedule C isn't just an informational disclosure about how your business is doing. It is the mathematical foundation, the literal starting line for your ultimate U.S. tax bill.
Precisely. And this is where the U.S. tax code asserts its dominance over standard accounting. Once you pull that line 22 GAAP income number onto Schedule H, you then have to make a rigorous series of book-to-tax adjustments on lines 2A through 2I.
Right.
These adjustments are governed by a very specific, incredibly detailed regulation, Treasury Regulation 1.964-1.
And these adjustments are where Congress basically says, we don't care what U.S. GAAP says is logical. We have our own rules for how to measure wealth.
Yes, you might have perfectly compliant, audited U.S. GAAP income from Schedule C, but Congress has decided that for tax purposes, we calculate certain economic realities differently. You have to adjust your inventory accounting according to the specific rules of Sections 471 and 472. You have to adjust your overall accounting methods under Section 446. And depreciation is a massive, highly scrutinized area of adjustment. Depreciation must be recomputed according to Section 167.
And there's a really specific punitive trap regarding depreciation and U.S.-sourced income that we have to talk about.
Yes, this is a perfect example of a hidden mechanism that completely alters the tax outcome. Normally, a company might use accelerated depreciation to lower its taxable income quickly by taking big deductions for equipment in the early years.
Yeah, very common.
But if 20% or more of the foreign corporation's gross income is U.S. sourced, meaning they're doing a significant amount of business tied directly to the United States, the rules abruptly change.
Wait, why? Why does the IRS suddenly care so much if a fifth of the money comes from the U.S.?
Because the IRS is fiercely protective of its primary tax base. Accelerated depreciation artificially lowers earnings and profits in the short term. If a subsidiary is entirely foreign, operating in a foreign market, the IRS might tolerate that temporary reduction in E&P.
Okay, they'll let it slide.
But the moment that foreign subsidiary starts pulling 20% or more of its gross income directly out of the U.S. economy, the IRS demands its full, immediate cut. They do not want U.S.-sourced income shielded by aggressive foreign depreciation schedules, so they force a mechanism shift.
Let's just shift.
Under Treasury Regulation 1.312-15, if you hit that 20% U.S. source threshold, you are legally forced to shift away from accelerated depreciation and use a strict straight-line basis of depreciation for calculating E&P. Straight-line depreciation means smaller, evenly spread deductions over a much longer period.
So mathematically, shifting to straight line means your deductions are smaller this year, which means your earnings and profits are artificially inflated this year.
Exactly. That single adjustment drastically increases the earnings and profits calculation on Schedule H, and higher E&P means a higher likelihood that any money moving around, or any Subpart F income generated, will be fully taxable to the U.S. parent company.
It's a giant interconnected Sudoku puzzle. If you change one single number on Schedule C, say, because an auditor told you to adjust a contingency reserve to satisfy U.S. GAAP, it creates a massive ripple effect across the entire return.
Oh, absolutely.
It changes Schedule H's starting point, which changes the book-to-tax adjustments, which changes your earnings and profits, which changes your inclusion amounts, which ultimately changes the hard currency you owe the U.S. Treasury.
And that ecosystem extends even further to Schedule M, which tracks transactions with related persons. The instructions dictate that the largest outstanding balances of accounts receivable and payable reported on Schedule M, those intercompany loans and debts, must logically align with the related party balances reported on the Schedule F balance sheet.
This raises an important question, though. In the real world, how do you ensure this ecosystem stays consistent? Think about the operational reality. You have local bookkeepers in Germany doing the initial trial balance in euros. You have U.S. tax CPAs in New York do the book-to-tax adjustments under Section 167, and you have corporate finance executives in Chicago looking at the U.S. GAAP consolidation for the shareholders. That's 3 different teams looking at 3 different frameworks, often using different software systems.
It requires an airtight, centralized reconciliation process. There must be one single source of truth that translates the trial balance all the way through Schedule M. And to underscore why that operational discipline is so vital, we have to circle all the way back to the beginning of our deep dive. Remember that 1997 Field Service Advice Memo regarding substantial compliance and the $10,000 penalties.
This significant item by significant item rule.
Exactly. That memo explicitly stated that significant inconsistencies reported for earnings and profits constituted a failure to substantially comply with the law.
Wow. So if Schedule C says one thing, but the adjustments on Schedule H don't logically flow, or if the $50 million intercompany loan on Schedule F doesn't perfectly match the related party transaction on Schedule M, the IRS doesn't just say, oops, minor math error, send us a corrected page and a small fine. They look at the whole form and say, this form is internally inconsistent, it cannot be trusted, therefore it is legally invalid, therefore you are subject to the $10,000 penalty, and we may hold your statute of limitations open indefinitely.
That is the exact legal reality. The internal consistency of Form 5471 is not just good accounting practice, it is a strict, uncompromising legal requirement to avoid devastating penalties. The IRS views these schedules not as separate documents, but as a matrix of data points that must perfectly corroborate one another to prove the U.S. parent truly understands its offshore operations.
This has been an incredibly intense, eye-opening journey. Let's do a quick recap to bring all these complex threads together.
Good idea.
We started by navigating the terrifying penalty landscape, understanding that a $10,000 fine is just the opening salvo if you fail to respect the significant item by significant item standard, or if you make the fatal mistake of filing consolidated foreign statements. We learned how the real-world workflow demands mapping a messy local trial balance to a rigorous, standardized chart of accounts, and then forcing that data into the strict confines of U.S. GAAP for Schedule C. We dealt with the mind-bending headaches of functional currency translation, including how the DASTM rules act as a necessary emergency switch, forcing companies in hyperinflationary economies to report in U.S. dollars so the IRS can measure reality instead of rubber ruler inflation.
The rubber ruler, exactly.
We snapped our year-end U.S. dollar Polaroid pictures for the Schedule F balance sheet, making sure to never, ever net our derivatives so the IRS can see the true, gross risk of the casino. And finally, we tied it all together, seeing how the Schedule C net income flows directly into the Schedule H earnings and profits ecosystem, requiring precise, punitive book-to-tax adjustments like the straight-line depreciation rule for U.S.-sourced income.
It is a massive undertaking, but I always tell practitioners it's important to recognize that while Form 5471 feels like an aggressive bureaucratic nightmare, it is actually a rigorous masterclass in global financial hygiene.
That's a great perspective.
If your company can successfully manage the granular data flows required to accurately and consistently file Schedule C, F, H, and M, you possess a level of operational clarity that most global companies frankly envy. Mastering this form forces you to become intimately, undeniably familiar with the absolute operational truth of your foreign investments. It strips away the obfuscation of local accounting quirks, ignores the noise of hyperinflation, and presents the naked economic reality of your global enterprise.
That's a really empowering way to look at it. It's not just a punitive tax form, it's an X-ray of your global business operations.
Yeah.
If you can read the X-ray, you know exactly how healthy the patient is. Which leaves us with a fascinating dynamic to consider as we wrap up this deep dive.
Yeah.
We live in a world of instantaneous, borderless digital commerce. Billions of dollars of intellectual property, software licenses, and digital services cross international borders at the speed of light, settling in fractions of a second. Yet, to govern this hypermodern economy, we are still relying on a tax and accounting translation framework that treats money like it's physical cargo being individually inspected, weighed, and categorized at a 19th century customs house.
It's true.
Every single transaction has to be unpacked, inspected for U.S. GAAP compliance, translated into dollars at a specific historical rate, and repacked into the rigid boxes of Schedule C and F. As business becomes ever more globally integrated and digital, will we eventually see the adoption of a truly universal global accounting standard that the IRS simply accepts at face value? Or will the friction, the cost, and the sheer administrative effort of translating local reality into U.S. tax reality just continue to grow? Something for you to chew on next time you're staring down a massive trial balance spreadsheet full of euros, pesos, or yen.